The Treasury Bills market here in Nigeria has witnessed a quiet week despite the Bond and NTB auctions this week. The traders at Axis Bank say they expect the bearish sentiments to continue due to a low level of liquidity in the market. Adamma Mbachu, team lead currency trading at Axis Bank, joins me to discuss activities in the fixed income and FX markets this week. Adamma, thank you for taking the time out to join us today.
Thank you so much, Esther.
Bring us up to speed. Let's start with market action for today across different segments of the market.
Okay, I'll continue from what you said. The fixed income market is actually experiencing a bearish trend, given the low liquidity in the market. So going into the money market, we saw the system liquidity open at 190 billion this week. However, the illiquidity was sustained given the various debits in the system. We had the bond auction where about 340 billion was debited from the system, and then we had an NTB auction where about 10 billion was debited from the system, and which is inclusive of about 130 billion NTB auction debit, while 120 billion NTB auction maturity, giving a net outflow of 10 billion. So we also saw other various funding obligations by banks, and as such, we saw the rate hover at this two-digit levels. The OPR is trading at currently at 10.5%, while the overnight is trading at 11.5%. We expect the rate to be at this level, given sustained liquidity in the market and further debit. We have the NTB, the retail auction happening today, and we have other funding obligations happening today. Though we expect FAC inflow to come in to create some sort of respite in the market, however, the market has not witnessed that inflow. Then moving into the foreign exchange market, we saw the rates hover around 419, 418 levels for the I&E. We saw continued interventions by the central bank. They have actually maintained those interventions for the SME and invisibles, for the foreign portfolio investors, and also we expect the retail auction today. Then going into the fixed income market, we mentioned the NTB auction, where the DMO sold a total of 130 billion across the standard maturity. The stop rates were maintained for the 91 and 182 levels at 1.71% and 3% respectively, while we saw a 19 basis point inch up in the 1 year maturity to close at 4.79. While the DM also conducted a bond auction today, they introduced a new 10-year maturity where the stop rate closed at 12.5% and the 20-year bond closed at 12.9 levels, while the 2025 closed at 10% levels. So we see continuous bearish sentiments in the market as portfolio investors and also the fixed income traders continue to sell down their portfolio, given the current illiquidity in the system.
Right. Speaking about the DMO, I'd like your perspective on this. You probably heard the story that the federal government, through the DMO, is planning to offer a second diaspora bond. The first one, which was offered in 2017, will mature in June this year. Just, of course, we know that this is all aimed at further bridging the, I believe it's over 7 trillion deficit for the 2022 budget. Your thoughts or your perspective on this story? Can we expect a second successful outing of a diaspora bond?
Oh yes, yeah, we are working on this, which is going to happen in a month's time. We're expecting a Eurobond of about 900 million. And like you said, it's just to bridge the budget deficit for last year and also to fund about the subsidies and all the talks around the subsidies. So we expect, we have had this before, and so we expect that it's going to be quite successful while also trying to boost our foreign reserves.
Now, since Monday, I've been talking to traders who have been telling me that they're seeing yields going up and they expect that yields will continue to go up. Investors are now pushing back and demanding more for their money. So what are your thoughts on that? We know that there will be more obviously significant borrowing at the domestic market on the part of the federal government this year. What are your thoughts?
Yes, sir, you're very correct. For 3 consecutive auctions in the NTB, we have seen consistent rise in yields, especially at the long tenured maturity, the 1-year maturity. And so, yeah, investors are quite aware of these changes and this inching up in rates. And of course, they will start demanding more returns on their investment, given the market trend in the market. So we also see that the government is also skewed towards borrowing more. So naturally, we see that this will actually spur increase in yields. So we expect to see that the rate will trend forward in the medium and long term.
Now, while the government obviously has to borrow more, at the same time, it's racking up its debt service bill, on interest rates, and of course, we know that debt service revenue is also an issue. I'm just wondering, is this something the government can afford going forward? And I'm just wondering, at what point could there be a resistance level, even on the part of the government?
Basically, I think the structural defect will actually be addressed there. The gap, borrowing gap, and all the deficit that we have seen. But however, I think the federal government actually played out its strategies very well. I think a lot of work will be done in terms of building up more strategies in how to close that gap, how to create sustainability around that. But definitely a quick fix now is what we are looking at. We are going to see more of borrowing, we are going to see more of rates going up, and I think the market is actually ready for that, and I've started adjusting to that trend.
Okay.